We're back with the second part of chapter 2. Now we're going to talk a little bit about income statement. This is how much has the firm made through a specific period of time, and how much have you been paying to make your sales, right? So the top line is called the revenues. So everything listed below the revenues are the expenses. Bottom line, probably you've heard of that concept before. The bottom line is basically the difference between revenues and expenses. The operating income is in the top part, and a summary of financial and tax structure is in the bottom part, right? That's basically the in a nutshell, this is how an income statement looks like. It's net sales minus cost of goods sold, and you have profit. Then you have other operating expenses. You have the earnings before interest, taxes, depreciation, and amortization. Um, then you get rid of depreciation and amortization and earnings before interest and taxes, and interest and taxes. And then once after you paid everyone else, you pay your stockholders. Now note, your cost is whatever you need to spend in order to make your product, right? Operating is whatever you need to spend in order to manage the firm. Interest, you pay that to your bondholders. Taxes, you pay that to the government. Then you pay your preferred dividends to your preferred stockholders, and if anything's left, you pay it to your common stockholders, right? These are the ones that are taking the most risk. These ones get paid once after everyone else has been paid. That's why we call them residual claimants, because they get whatever is left. That is not bad per se. You can be a residual claimant in Walmart and get a lot of money, right? So this is basically an income statement. You can see this example in your book. We also have a per share data. Earnings per share is basically how much income is available to your common stockholders divided by the total common shares outstanding. That is, the shares that are owned by someone different than the corporations, the shares that are owned by the market. Most likely we want this to go up. We want to have more earnings per share. That means that our corporation is being more productive. Now, dividends per share is how much dividends, or what are our dividends, that is the payment that we receive from the corporation since we are stockholders, again divided by the number of shares outstanding. This is how much do we receive for dividends per stock. Now, do we want this number to go up? Not necessarily, right? If we're investing in a corporation that is in a high growth industry, we might want them to reinvest that money, right? Why? Well, because if they reinvest that money, instead of paying us $1 as dividend, we can the price of the stock can go up by $3, for example, right? So we'd rather have the price of the stock to go up by $3 than just get $1 as a dividend, right? Now, book value per share is based on your accountants or your accounting records. How much is your corporation worth? Which is basically we add common stock, paid surplus, and retained earnings by the number of shares outstanding. This number tends to be less than market value. The market value is whatever the market says that your corporation is worth. There's no formula for that. You go to any financial web page and you will get that information right away. Market value changes constantly. Market value is very dynamic. Ideally, you want your market value to be greater than your book value. The greater your market value, the more that the market thinks that you are a success story. Now, we also have another statement called the statement of cash flows, right? That is pretty much how much money, cash, are you making within a year, right? Uh, Pretty much, the bottom line is the difference between where the cash is coming from and how are you using, and this should be consistent with your change in cash in your balance sheet. Uh, how can we get money? Well, increase liabilities or equity. Yeah, sure, right? If we get more debt, we get more money, right? If we invite more investors, we'll get more money. Or decreasing our non-cash assets, right? Now, uses. How can we use our money? Well, if we pay off debts or if we pay our investors, we're using our money, right? If we increase our non-cash assets, so we buy a building or a car or whatever, we're also using our cash flow, right? Um, there are basically three main uses or three main parts. Operating cash, which is cash that we make by the firm's normal business. Investing is the money that we make out of or using that money, and financing is the money that we get from issuing bonds or whatever it is, right? So this is basically it. Um, there's a big example of this in your book. I'm not gonna go into a lot of detail. Okay? Just statement of retained earnings. Basically, retained earnings is the savings of the firm. That's the money that they keep once after they pay their investors and once after they pay taxes, right? Um, so we need to make sure this is very important actually. When we're interpreting financial statements, we need to be cautious. Around 2000, 2001, there were several major bankruptcies due to the fact that they were doing some weird accounting methods, right? Uh, there are legal ways in which earnings can look more attractive than what they actually are. So you need to make sure that you're not a victim of one of those methods, right? Sarbanes-Oxley Act from 2002 has